in 2023, so last year, housing contracted, so it subtracted from growth about 0.9%. We have that turning around this year. We expect housing will rebound, activity contributing 0.4% to GDP growth. So once again, contributing positively to growth. With respect to housing prices, well, there's certainly considerable uncertainty around what will happen to prices, and it's going to obviously reflect the response in demand. But consistent with our forecast, we've got modest increase in prices compared to last year, where prices actually moved down. That's what's built into our forecast. What I can say, how will we manage the risks going forward? I think what you want to keep in mind is we're going to look at the whole economy. Housing sector is an important part of the economy, but it's not the whole economy. We're going to look at the whole economy. We're going to look at the amount of excess supply in the whole economy. We're going to look at the evolution of inflation. Housing is going to impact both those things. And as that plays out, that will influence our policy decisions. But we're not targeting housing, we're targeting inflation. We certainly do hear from developers that increases in interest rates are impacting their ability for their construction projects to be profitable, and that's delaying certain projects. Having said that, it's very clear in the data that the effects of interest rates on demand are much bigger than those on supply. Are we concerned that higher interest rates are affecting supply? I mean, obviously we are very, have been very clear. The solution to housing affordability is to get supply up. So that's a factor. But when you look at the tool that we have, interest rates, it's got more effect on demand than supply. If you look, the impact of raising our policy rate is actually to bring the housing market into better balance, not by reducing supply, but by reducing demand and bringing it more in line with supply.